Hello class, this is Professor Matt Dwyer. I'm glad to hopefully show you a video this week with improved quality here. We're here to talk about the balance sheet in all its glory. Um, Before we do that, I wanted to talk a little bit about the income statement, and that'll lead us into the balance sheet. So the income statement, remember we had revenues, expenses, showed our net income, and then after that, if we wanted to, we could pay out dividends to shareholders. Here's the thing. You might have heard the term double taxation. So when you have a C corporation, the corporation pays taxes on the net income. Then, if they decide to pay out dividends to shareholders, then the shareholders pay dividend at the personal level. Okay, so you have potential there for double taxation. There's a lot of people that think that's unfair. A lot of people think that there's bigger things to worry about as well. But when they say double taxation, that's what we mean. Now there's some vehicles to eliminate or avoid double taxation. The regular C corporation has double taxation potential. If you have an S corp, which has a limited number of shareholders, that income doesn't get taxed at the corporate level. The income rather flows through to the shareholders. So, for instance, the consulting work that I do, I'm formed or incorporated as an S corporation, which means that the income that I make after I've deducted all my expenses from my revenue, the income that I make is then flows through to me as an individual taxpayer. So if I make, say, $30,000 consulting, or if I made that in 2013, I would pay that at whatever my personal tax rate is. I would just pay that once. I wouldn't pay the corporate rate and then again pay the individual rate. But we're getting into personal income tax issues, but I just want to make you aware of that. So the income statement then also has, and we didn't have it this exercise, but it will have something called a depreciation expense. And depreciation expense is, excuse me, it's the amount of depreciation that was taken for that time period. So for the last assignment, if there was any depreciation, it would have been the amount of depreciation taken in March 2014. If it's a year-long income statement, it would have been the amount of depreciation taken for the whole year. Okay, so we see that on the income statement. When we transition over to the balance sheet, what we have is something called accumulated depreciation. Okay, and so you take all the accumulated depreciation that we've taken in previous periods, and then we add that depreciation expense from that last period, and we add that up. Okay, that accumulated depreciation then is usually netted against fixed assets. So if I have, say, $1 million in fixed assets, and then say 700,000 in depreciation or accumulated depreciation rather, my net fixed assets would be $300,000. So that is how depreciation is accounted for, one in the income statement and then two in the balance sheet. Now, if you recall it as a cash budget, we don't account for depreciation. Why is that? Because it's a non-cash expense. Okay. All right. So that's where we're at. So now we're at the balance sheet. And income statement showed us how much money we made for a period of time, whereas the balance sheet shows us where we're at as far as assets, liabilities, and then the difference, which is ownership equity, where we're at a certain point in time. So where we're at as of March 31st, 2014, where we're at as of December 31st, 2013. Okay, so let's talk about that. Assets. We know what an asset is. It's something tangible that we own. It can be cash. It can be a truck. It can be any other type of equipment. It can also be goodwill, where, say, Coca-Cola has that brand recognition. Well, in accounting terms, that's called goodwill. And that can be very tough to value, but accountants still try to value that. Okay? We won't talk too much about goodwill, though. So we've got assets. And then we've got liabilities. That's anything that we owe. Okay, so you're going to see accounts payable, that's a liability. Mortgage note payable, that's a liability. You can have a long-term liability. Okay, you also have current liabilities where that would be how you would accrue maybe for utility expense. assets. Okay, and a lot of times these will be projected, uh, but keep that in mind as well. Okay, so we've got that. Then we've got um, what's left over. Okay, so just like when we own our house, we've got what the asset, what the home is worth. Then we've got our mortgage. So if we've got a $150,000 house with a $100,000 mortgage, we've got $50,000 in equity. Okay, same thing with businesses. We've got we would have $50,000 in ownership equity there. Okay. Last thing too about the income statement, we had at the end on my notes, you'll see we had addition to retained earnings. Okay, that's similar to accumulated depreciation or depreciation expense rather, in that whatever that addition to retained earnings is, we add that to retained earnings on the balance sheet. Okay, and that's what we have left. What we have left over. That's basically our equity. Okay, you might hear it called retained earnings. You might hear it called common stock. There's additional paid-in capital, which is a little bit different story. For our purposes, a lot of those are synonymous. Okay, so just keep that in mind as well. All right, so now we know what the balance sheet is. Remember, it's assets, liabilities, and then ownership equity at a certain point in time. Okay, so now let's take a look at our balance sheet assignment for the week. Okay, so we've got equipment of 13,600, supplies of 900. There's a note payable 6,900, cash of 2,900. We have to calculate retained earnings. There's also the rent expense. Okay, so keep in mind this might be legitimate. Okay, but expenses, where do they go? They go on the income statement, revenues and expenses. Okay, we might have that expense coming up, but we haven't incurred it yet, or if we have incurred it, it's a liability somewhere else. Okay, so we're not going to worry about rent expense right now. So then it says prepare the balance sheet. Okay, so every one of these except the rental expense is going to be either an asset, a liability, or your ownership equity, which should be about the only thing. The only thing that would be there would be retained earnings. Okay. Then it asks you to ask you some questions. What does the balance sheet report? What financial statement reports the other accounts listed for the business? Okay. Let's see here. Kind of questions and things to look out for. This one is pretty straightforward. The only other thing that I will say about a balance sheet is, again, it's tough to determine how a company is doing just by looking at one balance sheet. Ideally, we'd love to compare it year over year or period over period. So if we say, well, how do we do this quarter from December or January 1st, 2014 to March 31st, 2014? Well, let's see how we did the quarter before that. Well, let's see how we did the first quarter of last year, things like that. When we're comparing different companies, either because we're thinking of taking an ownership stake in them or investing them, we would say, well, let's compare the balance sheets of the two companies. Okay, so that would be where we might say, well, gosh, this company has, not so much cash, has a lot of fixed assets, and then we say, well, how much depreciation is taken on these fixed assets? Okay, and that's important for two reasons. One, it gives us a ballpark idea of how new those fixed assets are, whether it's a manufacturing plant, whether it's a student recreation center at Olivet Nazarene, or anything in between. Two, it also tells us if we're a for-profit institution, how much depreciation we can then go ahead and take. Okay, how much additional depreciation we can take. So if I've got a new building, that's good on two fronts. Okay, so keep that in mind. Problem number two. Sorry about that. Let me silence my cell phone. A little more complicated. Okay, again, we've got expenses, and then we've got payables. We've got revenue. Think about where all these go. Just because we put it here doesn't mean that it necessarily goes on the balance sheet. Okay, common stock. You had common stock in your income statement assignment. We didn't put it in there. Think about where it would go. A lot of times you'll see retained earnings, and here you've got beginning retained earnings, and you've got common stock. which most likely would also be go in the ownership equity category. But then we also have to find that ending retained earnings. Okay. Accounts receivable, again, that's money that somebody owes us. We can count that as an asset. It doesn't mean we'll collect it. We'd love to collect 100% of our accounts receivable. But right now, that's an asset. Okay. All right. So keep that in mind. Now we're going to prepare the income statement and prepare the balance sheet. Okay. So we've got to delineate. Then we're going to answer a handful of questions. All right. So now we've got a chance to look at the balance sheet and the income statement and see if we're getting the same message. And if we're not getting the same message, how come? All right, so we just look at Gates City, and we see they've got $3,000 cash on hand. They own a building worth $145,200. Let's see what kind of payable. No payable. Okay, maybe that's on the building. That could be. So that means just in the building, they've got about $113,000 worth of equity in there, right? Building's worth $145,220, and if we say, well, the note payable is $32,000, it's the difference, just like when we own a house. Okay. Then we say, how much money does the company owe to creditors? Okay. So again, that's debt. Debt is a liability. Okay, it's different from an expense. Keep that in mind as well. Let's see here if there's anything else I want to touch on. Talks about the stockholders' equity in the business at the end of the year. And I gave you some notes here. All right, so this is the last week where we're kind of doing these types of exercises. Maybe you like it, or maybe you're ready to move on to something else. But I'm kind of excited to move on to something else, kind of these case studies. Okay. That are coming up. And week 5 talks about the Hampton Machine Tool Company. And one, it's a fairly old business, but it's starting to grow. Okay, so there are going to be 2 issues. These are kind of like becoming attractions here. You've got one, we've got some fairly old equipment. Okay, and then 2, though, we've got potentially a cash issue because we're growing very fast. Okay, so keep that in mind. I'm going to let you go. I've enjoyed it. If you have questions, make sure that you come talk to me. Email or phone 815-295-3994 or MD as in dog, WYER@owlvet.edu. Have a great week. God bless, and I'll see you on the discussion boards.